Hey, Grace here with Let's Chat, and today I have Zack Nelson here with First Bank. Zack, we're so excited to have you here. I've been working with Zack for over a year, and he's got an amazing background. So Zack, let's give us a little bit of a background about your lending
Yeah, yeah,
experience.
absolutely. Well, hey, as always, it's a delight to come in here and get to chat with you, Grace. Yeah, background on me, I've been lending now 4 years. Really enjoy it. I kind of lend nationwide with both investors and primary purchases. Really kind of keeps you on your toes because
It does.
guidelines and regulations are always adjusting, scenarios and programs are always adjusting, and so I kind of have to be a sponge and really stay on top of things to make sure I'm able to help you and your clients
Mhm.
be prepared.
And you're an investor yourself,
Yep, that's right.
so you
Yep.
can really, get what's going in an investor's head and, the trials and tribulations of being an investor.
Uh,
So,
Absolutely. That's one of my favorite parts of my job. I always like to tell investors, hey, whether that's, just let me know if this is a professional call or a personal one, because I just love kind of being a sounding board, talking through, cash flow strategies, updates, things that are going to make sense from a valuation standpoint or not, and
yeah.
helping people grow their portfolio. It's really fun.
It, you know, Investors have been a key part of my business since I started in real estate. And so let's start with investors since we're
Yeah,
kind of on that topic.
absolutely.
What trends are you seeing in the market for rates across the programs for investors right now?
Yeah, fantastic question. So, investment rates, I always like to kind of give this disclaimer, have always trended above primary rates. So, it's one of the first thing when I'm talking to a first-time investor is saying, hey, primary rates are going to be lower, just to set expectations. And the reason behind that, not to get on my pedestal here and give boring reasons of mortgage, but the idea from Fannie Mae and Freddie Mac is saying, hey, at the end of the day, you will beg, borrow, and steal to pay for the roof over your own head. But the first thing, if everything goes awry, that you'll miss a payment on is an investment property. So because of that, risk is passed on in the form of a little
Hmm.
higher rate.
Right.
But rates have dramatically improved from even July. If we look back at that, investment rates were up in the mid to high eights, nines in some scenarios. Now we have the ability, depending on down payment and program, to be knocking on the door of the high sixes, playing in the sevens space,
Hmm.
which is really radical improvement when you talk about where we were just even 2 months ago.
Oh, huge in
Um,
terms of cash flow, cap rate. It's so what are minimum down payment thresholds right now for investors?
yeah,
And what are some options for
yeah,
them?
yeah, really cool. So when we look at an investor, it really depends on what they're trying to do with the property. So if they're saying, hey, I want to buy this lake house that I'm going to go to a weekend or two a year, but I'm going to Airbnb it, we can
Hmm.
start with 10% down with that.
Oh, really?
Yeah, which is really cool. You can short term rent and even midterm rent a 10% down second home.
Okay.
You have to be able to qualify and carry that debt, but as long as you qualify for that, it's a great low cost to entry. When we look at investment side of things, single family homes start at 15% down,
Hmm.
which is the federal guideline. And I know, speaking to a lot of my peers in the industry, their companies have what's called an overlay where it says, hey, we know that the federal guideline says 15%, but we're going to require 20% down. So we open the door at 15%. Multifamily is 2 to 4 units is 25% is where that starts.
Right.
Um, but DSCR, so I'm going to give you a nice buzzword here, debt service coverage ratio loans.
You love those.
I absolutely love them because they're so easy. I do, we gained access to them about 18 months ago, and I probably do 3 or 4 a month with investors because they see the light of documentation. It's
Uh-huh.
basically, hey, where's the money coming from? Is this house going to be good renting? Here's your money. So it's very, very easy. They don't have to follow the traditional guidelines of running out of how many homes they can finance from conventional standpoint, so that you can really grow their portfolio. So, but they will allow a multi-unit to be 20% down. So that's something that I've been
That's
doing a
great.
lot more with investors is saying, hey, usually one of the biggest barriers of entry for investors is the down payment.
Right.
If you're looking at a $400,000 home, coming out of pocket $100,000 plus closing costs can be a
Hmm.
bit of a journey. So DSCR opens the door to say, hey, 20% down can work. And the last thing I'll put on that, because I've said a lot here, is what I try and preach to investors is the single biggest impact on your interest rate isn't your credit score, isn't your debt to income ratio, it's down payment. So while we open the door at 10% or 15% down, that's going to carry with it the quote unquote worst rate because the risk mitigation we talked about earlier.
Right.
As you shift up, the more you put down, the better your rate will be, which caps out and maximizes at the 25% down.
Okay.
So if someone is really rate conscious and they're like, hey, I could do 15% down, but what does 25% down do for me? In all likelihood, it is going to be a substantial difference on the rate.
So it'll be a better return on your investment with the
Exactly.
investment property.
Exactly. You're going to maximize your cash flow.
Right. A better cap rate. So what are you seeing for timelines right now? How long is it taking to get loans processed and completed with investors?
Yeah, fantastic question. And this is something that we kind of saw, if we zoom back in our time machine to 2020, 2021, where appraisals were on, heck, 40-day turnarounds, right? Title work was on
45.
Yeah, we'll get it to you as soon as we can. We aren't back to that, but the market has begun to heat up again, and we're starting to see, couple week turnaround, 2 to 3 week turnaround on appraisals. That's both locally here in Chattanooga and nationwide. And then the same with title work is saying, hey, it's going to be 2 or 3 weeks. From a processing and underwriting standpoint, I can't speak on other lenders, but for us, we can still zoom you through in a couple days. So that part isn't an issue, but it's one of the things that we always want to be cognizant of when we pull in a 17-day contract. Hey, how quick can we get title? How quick can we get appraisal?
Right. Well, and that's, as the market kind of heats up a little bit, the turnaround time could make a difference with an investor actually being in the forefront or not. So
Absolutely.
that's kind of important. And you guys are great at communication. I've had a lot of my clients that I'm seeing it, they're seeing it, we're on top of it. You go above and beyond for communication, which is really important.
Yeah.
So how many homes can an investor have in their name and qualify for conventional financing?
Yeah, great question. So this one is a really cool. So, zooming back, the conventional space is the sandbox that we all play in. The rules are black and white, but you can take advantage of tools that they have given you to work around this and still play in their sandbox. So the Fannie Mae Freddie Mac rule is 10 financed properties. So not even owned, but financed properties. So if you have 10 Fannie Mae Freddie Mac, then you hit your cap.
With each lender or
with
total?
Total. Yep.
Okay.
So overall. And in a really cool way around this, and I've helped clients grow from 1 to 5, 10, 15, 20, is once you have a filed tax return for a property, and almost all investors are doing this already, is if you shift the title holding to an LLC,
right?
Which most investors want to do anyway, but they don't have to. But
it's smart.
From the the legal, the tax,
right?
It makes sense.
Yeah.
And that's perfectly okay in the eyes of Fannie Mae, Freddie Mac. They say, hey, if you own this LLC, we don't care. Once you have a filed return, you can exclude that mortgage. So you could, in theory, and I have clients who have 15 or 20 conventional mortgages in their name. Once you have that filed return, you can exclude that, which is a really cool way. We don't have to account for it on the debt to income, and it does not count towards their 10.
Oh, wow. That's
so
great.
it's a really smart way to work around it.
Okay.
And it's perfectly within their rules. And then, one step beyond that, if they're saying, hey, we don't want to do all that. We don't want to deal with the LLC aspect. We want to like these in our name. DSCR loans don't care. They'll take up to 50 in the end.
50?
Up to 50.
Holy Toledo.
Which if you got an investor that has 50, they probably are doing other stuff too and probably have LLCs and everything. So, but yeah, the DSCR is a good backdoor way, but you can play within the rules and still get those friendly conventional rates and lower costs.
So is it better to get closing costs paid for or reduce the price?
Absolutely. So to me, I'm a big advocate for saying, hey, on an investment, the seller can give you up to 2% of the contract price,
Mm-hmm.
and still fit within the guidelines. So if we're, let's use arbitrary numbers here because that's easier for me. I'm a simple guy. Is, hey, they can give us 5 grand towards closing costs or 5,000 off of the contract price. And if we're looking at it and saying, hey, what is going to maximize my return on my investment?
Mm-hmm.
I would take towards the closing costs because you can leverage that money to buy your rate down, to reduce your upfront costs. At the end of the day, 5,000 off of the contract price is going to be extremely marginally
Pittance.
impacting on your cash flow and on your monthly payment.
Mm-hmm.
If you can turn that around and say, hey, I'm going to drop my monthly payment $100 as compared to dropping it 10 or 15,
Mm-hmm.
to me that makes sense. So
Well,
that's
it's
something I'm a
leveraging it. So the
yep,
closing cost leverage
yep,
versus price reduction really doesn't.
yep. So
Okay.
I'm an advocate of that.
Well, great. So, okay, switch hats.
All right, there we go.
Now we're going to go to sellers.
Yep.
It's a really interesting time for sellers. They want to find a property before they close on their house. It's kind of challenging at times to make all those puzzle pieces
Yep.
come together in a perfect fit.
Hmm.
So, you have an interesting concept for sellers
Yep.
that I really love.
Yeah.
Tell us about it.
Yeah, absolutely. And certainly whenever you have, all the dominoes lined up for buying and selling a home, it's about how can we simplify this as much as we can. And I'm a huge advocate. I've been using this for years. It's called recasting.
Mm-hmm.
And it really works in everyone's favor. The best way to describe it, or most simplified, because it's certainly outside the box, is a delayed down payment. So let's use this example of client either owns their current home outright,
Right.
or they have great equity in it and the payment's very friendly on it. They love this house. It's a competitive offer situation. The sellers have already come out and said, no way are we accepting a contingent offer.
Yeah, they're just sellers are just not going to do it right now.
Yeah, and I understand, because it's one thing that you are not in control of,
Mm-hmm.
when you're selling. So what this allows you to do is offer without being contingent on the sale of your home. A bunch of ways to attack the cash to close, but let's just say that they have enough for a 5% down payment.
Mm-hmm.
We put 5% down on the purchase of the new house. As soon as the old house sells, whether that's, hey, maybe we get lucky and it closes back to back,
Mm-hmm.
or it's a week or two after closing. Once we have those funds, we take them and we apply them directly to the principal of your new home. It doesn't reset your clock. It's not a refinance, so you're not paying all these closing costs. It's a one-time fee of $399. It re-amortizes it and adjusts your payment as though you had that money from the beginning.
Interesting.
So it's really cool. It's outside the box, but it's a low-cost way to offer without being contingent on the sale of your current home. Apply those funds, get your payment where you always wanted it.
Mm-hmm.
But sometimes buyers want more time too. They're saying, "Hey, we want to work on the new house before we move into it," and so it's not even a situation of could we do this. We want more flexibility. So it just kind of gives everyone a little more of a leash, and takes one of the stressful aspects out of the
Well,
process.
yeah, I mean, because that's a really big challenge for sellers right now. They want to downsize, they want to move, they want to get their house sold, but the timing of finding the perfect house, getting their house sold at the same time, and not having contingencies is really, really difficult to do.
Yep.
And, so I think I love this recasting idea. I think it's a great avenue for sellers to really seriously consider, particularly when they don't owe any money on their house.
Yeah, absolutely. In that case, it's you don't want to say it's a no-brainer, but it's certainly something that is very big risk mitigation for them. If they already own their home outright, they're going to be able to apply whatever amount of those funds that they want directly to the new one.
Mm-hmm.
They aren't going to be worried about carrying two mortgage payments because they own the current home free and clear. So
Right.
to me, it's a slam dunk, and it puts them, because at the end of the day, that's a big part of my job, is how can I put a buyer in the best position they can be, especially now as we talked about the market heating back up, where
Yeah.
it's competitive again. That's one way to give them a leg up.
Well, I think it's crucial to a listing as well. when you have somebody that's looking for a place to buy as well. So I'm a big fan of the recasting, and I'm recommending it to 2 clients this week.
Hey, there we go. I like it.
Okay, one more hat pivot. Now we're going to
Let's
go
do it.
into primary questions. Just
Awesome. Yeah.
primary,
Bread and
somebody's
butter. I
bread
like
and
it.
butter. Somebody wants to buy a house.
Yeah.
So what's the range of down payments needed right now?
Very, very good question. With primary homes, when we talked about investment, it has a set threshold because of risk mitigation. Primary homes, the top barrier of entry is cash to close, especially and specifically for first-time home buyers.
Mm-hmm.
So from a first-time home buyer perspective, we have some really cool options where 100% financing, and even in some scenarios above the 100% to assist with closing costs as well.
Oh, wow.
So really, really cool benefits from that perspective. When we look at some of the more, hey, I currently own a home, or I've owned a home within the past 3 years. That's a cool workaround too. If they've owned before but they've been renting,
Mm-hmm.
then they technically after 3 years are first time home buyer again. But if they've already owned a home, currently own a home, 3% is available pretty much exclusively to first timers, but 3.5%, 5% down. And really, to me, 5% down is the best route for a buyer, just because their rate is maximized.
Mm-hmm.
And on top of that, the appreciation that we're seeing in our market here, they're going to quickly get into where a couple years down the line, they can likely, get that PMI removed.
Right. Oh,
And
because of the appreciation.
yeah, because of the
Oh, that's
appreciation.
smart.
And then to me, I never want a buyer to be scraping their pennies under their couch for their cash to close and having no reserves. Because
Right.
when you buy a new house, home ownership is one of those things. It's kind of like buying tires, right? It's one of the least enjoyable aspects is cost that can pop up.
Mm-hmm.
And first time home buyers routinely need to make sure they have a good reserve, because you never
You
know
never
what's going to pop
know.
up.
Yeah.
So I always, if we're looking between a 5% down or a 10% down or even a 20% down, I almost always advise to put a little less.
Mm-hmm.
Make sure you're comfortable with the payment, but put a little less and hold back some strong reserves for rainy days.
Yeah, that really makes sense. Um, can they get a gift for closing?
Yeah. So gift funds are one of the great additional tool belts that Fannie Mae and Freddie Mac provide to us. Any family member. So it can't be somebody you met on the street or you bumped into at the mall, but any family member, cousin, uncle, parents, grandparents, can assist with funds for closing on conventional and FHA and for primary purchases. But the really cool update to this that I want to talk on is the FHA updated their gift requirements.
Oh,
So
great.
they are now in aligned with conventional, which is if someone is gifting funds and they wire it straight to the title company or cash your check straight to the title company, we don't have to document those funds.
Oh, that's huge.
And that has almost always been one of the hardest things. And I completely
Biggest
understand
challenges.
is, hey, Johnny told me that he needed some money for closing. It's not a problem. I told him I'd help him out. But Johnny's telling me that you need 2 months of my bank statements. I'm not giving that to you.
Yeah.
And I'm like, hey, I completely understand. I'm someone that you've never met that I'm asking for your private information. So I think FHA understood the feedback of saying, hey, this is, it's a little intrusive. So they've backed that off as long as they send it straight to the title company. Now, if they give it beforehand, you have to document it. So that's always, if anybody takes anything away from our conversation here, if you're getting gift funds at closing, please give it straight to the title company. That makes your life easier.
Yeah.
It doesn't matter to me. At the end of the day, I'm going to help you get there, but it'll make your life easier if you just send it straight there.
So what are rate trends looking like in the short and long term right now?
Yeah. So if we zoom back 2 or 3 weeks, the Fed did what we had hoped they would. And funny thing about rates, and I've been preaching this so much, I feel like I hear it on repeat in my head, is rates are almost more impacted by what the Fed will do than what they're actively doing.
Mm-hmm.
And so we saw this awesome lowest rates in 2 years standpoint a few weeks ago when the Fed made their first cut. And since then, because mortgage interest rates are not linear. It's kind of stair steps. So we've seen
Mm-hmm.
some regression. So the past week or two, it's kind of slowly slipped a little bit back. We're still in a great spot. I hate to give a specific rate just because there's so many variables that go into it, but we're playing in the low sixes space. I think if
Mm-hmm.
you look at national averages right now, um, that's great for the short term. We should be settling around here, I think, for probably a few months.
Okay.
And then as we go into the top of next year and into the winter and spring, they should continue to move down.
Oh,
So
that's good.
so rates are they're they keep us all on our toes, and this is my life, and I still have to do a lot of research to see what analysts, and at the end of the day, I don't have a crystal ball.
Right.
If I did, I'd be way better at my job. But it's short term. We've improved so much in 2 months. Midterm to long term. So it's looking into next year, we should continue to trend downward.
That's good to know.
Mhm.
So how does a buyer enhance their offer in a competitive seller situation and from a lender's
Yeah,
perspective?
yeah, absolutely. So when we're looking at competitive offers, the first thing people always point to is, hey, we'll go over list, and if you're looking at a situation where maybe everybody's offering over list. So let's just pretend everybody is offering 5,000 over list. So ways that a buyer can enhance their offer without sticking their neck out too far. One is to offer over appraisal or cover an appraisal gap.
Hmm.
Um,
Oh, and that's a good question. So you can buy appraisal insurance.
yes, so you can mitigate, some of your costs and difference, and there are I think third parties that are offering that. And when you look at that same scenario of, hey, 5,000 over list, everybody's doing it.
Hmm.
Well, we will pay 3,000 of an appraisal gap difference. So,
Your first bank will, or
I apologize. No, that's a way
oh,
to build into the
the
contract
the
for
buyer.
the buyer to
Okay.
say on that.
Okay.
Now, what I've been seeing lately, and every situation is different, so I want to give that huge disclaimer, but the market has been in a really good spot of appraisals being where they should be.
Right.
Um,
In general.
in general,
Yeah.
and broadly speaking.
Yeah.
We when the train wasn't even on the track, it was upside down in 2020 and 2021.
Yeah, it was
And
challenging.
and so then you were seeing offers 50,000 over list, and an appraiser is not a magician. But again, back to, I easily got sidetracked, so I apologize. But we offer a few thousand over the appraisal gap. What that means is if it came in low, say it came in 10,000 low, they're going to be on the hook for 3,000 of a difference. If they're putting 10% down, so basically anything over the bare minimum. So if they're
Right.
putting 6% plus down,
Mm-hmm.
their cash to close, even if the appraisal came in a few thousand low, is going to stay the same.
Mm-hmm.
Their payment is going to be based on a lower amount, so their payment's actually going to shift down a little bit. So it's a good way to protect them
Yeah,
and be more appealing to the seller.
that makes sense.
Another way that's really competitive for a buyer, and we talked about it a little bit earlier, is timeline.
Right.
So many sellers are like, hey, I want to sell this as quick as I can. And we routinely pick up rescue deals from other lenders in town who have either denied or just couldn't get it done,
Mm-hmm.
and we turn around and we close in 2 or 3 weeks. Now we can't do that all the time, but that's when I say to a seller is, hey, 24 days, 22 days, that's not crazy for us. That's not a rush. That's something we can pull
Normal.
off. So to me, the shorter timeline, as long as everyone is on board with that,
Mm-hmm.
is a great way to be competitive when we're looking across the board.
Well, that's good to know. Any final words of wisdom for buyers right now?
Yeah, my 2 cents, and it's hard for me to probably come across as genuine on this because it's my industry, but my 2 cents are, if you're looking to buy in the next few years, the next few months are probably going to be your easiest time to do that. Just because there's so much pressure being pushed down on rates to have them move in a positive direction. But even to add to that, there are so many folks who are sitting on astronomical amounts of equity that
Mm-hmm.
bought in 18, 19, 20, and they're ready to move, but they have this 1.95% rate or something. They're like, I
Right.
can't get this up. But as rates get closer, someone will give up a 3% rate to go to a 5% rate if they have $200,000 in equity, because that's going to, eat into it and probably keep their payment fairly in line. So,
Right.
you know, my recommendation to buyers is have a conversation with a lender. I'd love to talk to you if you have a relationship with someone else. Talk to them.
So how do
And
people get in contact with you?
yeah. So I guess give my number on here. I
Yeah.
guess on here. All
Uh-huh.
right. Yeah. So my website is Zack Mortgage, ZACKMORTGAGE. I think I spelled that right.
Yeah.
And then phone number is
.com.
.com. Yep.
Oh,
Sorry.
wow, that's a
.com.
good one.
Yeah. I got lucky.
Yeah.
And then phone number is 269-209-0123. But just look at your options.
So the phone number one more time.
Yeah. 269-209-0123.
Okay. Well, I've always loved working with Zack. He's great with buyers, investors. So, if you're thinking about getting off that fence, give Zack a call today.
Yeah.
Thanks, Zack, for joining us. We
I
appreciate
appreciate
it.
you.